Welcome back to another Tax Tuesday. We're continuing on with our discussion from last week with Ruby Chohan. Now, Ruby leads the real estate division at Trowbridge, and she is also a very experienced realtor in Toronto, so is exceptionally well equipped not only to answer questions about real estate and real estate tax, but if you're in the need to find or sell a home back in Canada, Ruby, you're the person to speak with. Welcome back to another episode.
Thank you so much. I'm so excited to be here again and share all my knowledge and expertise with all of our Canadians abroad.
Let's continue on with what we were talking about last week. Now, there are a lot of Canadians who are considering to purchase a home back in Canada, but they might not be moving back in the next few years, so 2 or 3 years. So I guess that purchase could be considered an investment, right? So if someone wants to purchase an investment or a property for themselves to live in when they return to Canada, what are the different options that might be available to them?
That's a good question. I think usually people only think of one option, which is resale, but there's three main ways to get into the real estate market in Toronto, whether you're local or whether you're abroad. And I'll briefly go over these. First one, resale market, meaning it's not a commercial transaction. It's already a built property. It's already owned. It could already be leased. There could be tenants in it. It's listed for sale or for purchase on the MLS, which is the multiple listing service, which everyone has access to. They can go online and check out which properties are on sale. In those situations, it could be an offer night, offers accepted anytime, but pretty much you're buying a built home that you can already see. That's option one. Option two, I would say, is pre-construction, meaning you're purchasing a home that is either already in pre-construction stage or it will be built at some point. It'll be built down the road. It could be 3 years from now, it could be 5 years from now, 6 years, etc. However, when it's pre-construction, it's considered a commercial transaction. So there are tax implications that come into play. As a non-resident buyer who's buying pre-construction, at closing, if it's not your principal residence, you must pay HST on top of the purchase. Now, I would say don't be so scared that, oh my God, I'm going to have to pay all this tax and I'm never going to get it back. Why would anyone buy pre-construction? Well, for investors, when you have a pre-construction property and you've rented it out, there are rebates available, such as the HST, GST, new residential rental property rebate here in Ontario, where you can get rebated up to 24K back. And the way builders work in the calculations is it's not a quick whatever 13% is of the tax. They build it into the price, purchase price. So that's a consideration pre-construction. The benefit of pre-construction is that you can buy a home today for 500K, and then once it's built, the values increase by a few $100,000. And at that time, you could continue owning it. You could sell it before you even get it rented or get the keys, or you can also refinance at that time, meaning if the values increase greatly and you need to get a mortgage on the property, if the value is a lot more than how much you actually paid for it initially, you could potentially take that money out at the time of closing and then buy another property or do whatever you like with the money. That's the second option. The third option, which is assignment transactions. I find a lot of non-resident and Canadian citizens are interested in these. Now, essentially, an assignment transaction is when a buyer, we'll call them the assignor, they have purchased a pre-construction contract and maybe the building is almost going to be done, the home's almost complete, and they've decided not to proceed with the agreement. There could be many reasons. Maybe they are not able to afford the final installment. Maybe they just don't want to live in it. Maybe their family situation changed, whatever it is. It allows you as the buyer, as a non-resident, to purchase the home without having competition. The assignment transactions are not marketed on MLS, the multiple listing service. So sometimes they can be hard to find. Working with an experienced broker, you will have access to a lot of assignments, such as myself. And the benefit of assignment is essentially you're paying the initial deposit that the original buyer paid to the builder, and you're also paying that difference in the value now. For example, like I said, someone can buy a property for 500, now it's worth 700. They want to sell it, they want to take that 200K profit. So if you're in a situation where you have a large cash output, It's a good way to get into the market and buy a totally new property without competition. Those are three main ways.
So is there anything really critical that one should keep in mind while they're looking for a place to purchase?
Yeah, absolutely. So I think the tax component and also the financing component is the most critical. Of course, working with the right real estate broker who has your best needs in mind and all of that. But tax wise, if you're a non resident and you're not a Canadian citizen, then whether you're investing in Ontario or whether you're investing in BC, you will be subject to the foreign buyers taxes, the non resident speculation tax. In BC, that's 20%. Here in Ontario, that's 15%. So those taxes are registered at the time of closing by your real estate lawyer. So it's really important that you work with a real estate lawyer that understands your immigration status and whether you're subject to that tax or not. And those foreign buyers taxes, so essentially, they're based on immigration status rather than tax residency status. So if you're a Canadian citizen, but you live abroad, then you're exempt from that tax. And then also, if you're purchasing property, will it be a rental property? If it won't be a rental property, then you must consider the empty homes tax, the vacant homes tax coming to Toronto and the one in BC. And on top of that, the speculation and vacancy tax in BC. So you have to consider your ongoing costs. I would say if you are purchasing a property anywhere in Canada, rent it out, allow someone to live in it. It provides housing to your city and your back home here in Canada. So I would just say those are the more purchase related costs and ongoing costs related to vacancy. And I'm sure we're going to discuss rental related tax withholding and filing requirements. So I'll just hold off on that one.
Sure. So on that whole topic about rental properties, I know that can be a little bit of a thorn in your side, especially if you're living abroad and you're looking for a renter. Having a property manager, I would imagine, would be super useful. Do you have any advice for anybody who's looking for a property manager?
Yes, absolutely. So as a non-resident, especially if you're living abroad, everyone, they consider maybe I'll give it to my aunt or my cousin or my friend to look after the property and deal with it all. I do not recommend that at all for multiple reasons, including tax reasons and just regular property management reasons. As when you have a home, anything can go wrong. It could be the middle of winter, especially here in Canada, when it's really cold. Your pipes can freeze at night. Your hot water tank can burst, all these different things. So when searching for a property manager, I recommend having someone that has a 24/7 emergency line. So that someone can come go to the property or call a contractor or do whatever. Someone or a company who's very familiar with the landlord and tenant boards of your province that you're living in. Here in Ontario, for example, our landlord and tenant board much more favors tenants than landlords. So it's very important that you're familiar with the rules and requirements as a landlord. And on top of that, when it comes to taxes, as per the Income Tax Act, the payor of the rent to you, which for example could be a property manager, is technically responsible for withholding tax. However, as a tax professional, we always recommend working with an accounting firm who's an expert with the CRA and non-resident tax withholdings to handle the tax withholding requirements. So it's really important that your property manager has a general understanding and overview that you are a non-resident and these things are important so that they can put you in touch with an accounting firm or with us here at Trowbridge and just make sure that your needs are covered.
So, talking about, again, getting to sort of the tax implications, but if you have a home that you're using as an investment property, what sort of tax implications are there?
So, as a non-resident rental property owner, there are tax implications when it comes to rental income. Now, the concern is for many non-residents, I live abroad, I don't live in Canada anymore. I don't want to pay any more tax to Canada. However, when you earn income in Canada, CRA, Canada Revenue Agency, which is our taxing authority, is the first one to tax Canadian income. So for non-residents who earn rental income, There's actually two different divisions that come into play at the CRA. One is where they file tax returns, called the individuals division. And there's another division called Part 13 and non-resident tax. Essentially, this division looks after all non-residents at any sort of income they earn. And they want to make sure the correct amount of tax is withheld in case a taxpayer doesn't file an income tax return and reports the rental income. So the CRA, they give you two options to withhold tax as a non-resident. The first option we call the gross method. Essentially, and I'll break it down to three parts. Essentially, the CRA wants you to withhold 25% of your gross rent every single month and pay that to a non-resident tax withholding account. So part one, you're constantly withholding 25% of the gross rent on a monthly basis. You're paying the CRA. Part two, you receive an NR4 slip, which is a non-resident tax slip, indicates the amount of tax you withheld, and it's included with your tax return. Then as a non-resident, there's a specific tax return that specifically reports rental income and rental expenses. And when you withhold 25% of the gross rent, because it's a pretty large amount, the CRA gives you up to 2 years to file your tax return. You know, maybe they're not in a rush to refund you your money based on your net income. But anyway, so you have 2 years to file your tax return, and then you're assessed on your net income after all of your rental expenses. A benefit to investors is that almost everything related to your rental property is tax deductible, such as accounting fees, legal fees, maintenance and repairs, mortgage interest, which is a very big one for most people. So that's option one to withhold tax. Option two, which is what I would say 95% of people choose, is we call the NR6 form option. You have to have a third party such as Trowbridge who is registered as a tax withholding agent, and you can submit a form that allows you to withhold tax based on your estimated net rental income. So the form is filed at the beginning of the year. Once it's approved, you're allowed to pay reduced taxes, and you're paying a lot less compared to 25% of the gross. And imagine if you estimate more expenses than income. There are situations where people do have more expenses than income these days, especially with the low rental rates. So if you're estimating $0 in net income, you can end up paying $0 in tax upfront to the CRA, which is much better than them holding on to 25% of the gross rent, as you can imagine. So it's broken down to three parts. Part one, NR6 form is submitted to CRA. It's approved for you to pay less tax. Part two, the following year, we at Trowbridge prepare your NR4 slip. It says the amount of tax you withheld under our non-resident account. It'll say you had an approved form that allowed you to pay less tax. And this is where it becomes a little bit different. Part three, the CRA has a very, very, very strict tax deadline of June 30th of the following year because they allowed you to pay less tax. So, they want to make sure you file your tax return in a timely fashion and pay any additional tax owing to them by June 30th. And if you fail to file your tax return, your Canadian agent, such as Trowbridge, who signs off on the form that allows you to pay less tax, will receive an assessment, a penalty of 25% of the gross rent for failing to file your tax return on time. So it's really, really important that if you earn rental income as a non-resident, that you're compliant with the tax withholding and filing requirements. You just have to get them in place, set them up with your accounting firm, such as Trowbridge, and do them on an annual basis, and you'll be fine. Now, the main concern is if you don't withhold tax. I come across a lot of situations where someone's selling their property and they've lived overseas for 10 years and they never withheld non-resident tax. Well, the CRA's penalty for failing to withhold tax is 25% of the gross rent for all the years that you earned rental income plus arrears interest. So, if you're in a situation like that, I say come chat with us and we'll figure out what your potential next steps are, if there's any way around that penalty. So yeah, those are the main concerns when it comes to rental income.
Could be a big ouch.
It could be. So you want to make sure that, well, here's the thing. So if you're considering purchasing a property, reach out to us. We can always do a tax consultation. We can go over your tax residency, because sometimes it's not only about what's happening in Canada. It's also about how does ownership in Canada affect your tax residency status wherever in the world you are. So there's additional tax implications that can come into play. It's just about figuring out what it is, what needs to be done, and getting the ducks in a row.
Now, what about the sale of that investment property? Say somebody has decided that for whatever reason, having a revenue generating rental properties is not what they want. They decide that they want to sell that investment property. What sort of tax implications, or how does that differ from somebody who's gaining that rental income?
I think this is a great question because I see both sides of the coin. I see why buyers really want to invest in Canada. Our market is great. We have a lot of immigrants coming to Canada each year. I believe 400,000 have been approved for 2021. And, businesses continue to invest in Canada. And I also see why a lot of sellers want to sell their properties in Canada. It's a great time to sell. They've built a lot of equity in their homes. On top of that, maybe they just don't want to deal with the tax implications anymore. They don't want to withhold tax. They don't want to deal with the property manager. They don't want to deal with tenant issues, especially in situations like right now, as we're in the pandemic. There's a lot of tenants who perhaps just cannot afford their rent right now, and homes are occupied without receiving rental income, which can be tough for the homeowner as well. So, as a seller, as a non-resident seller of Canada, whether you're selling property, transferring property, or gifting property to a third party, such as a family member or a child, there are tax implications. There's something called a certificate of compliance application and non-resident tax return requirement. So a certificate of compliance application, essentially it calculates 25% of your net capital gain. And within 10 days of the final closing, it must be filed to the CRA. If you fail to file the certificate of compliance application, there's penalties minimum of $100, maximum of $2,500 per non-resident owner. So essentially, the applications are filed within 10 calendar days. There's multiple forms and applications for whether it was your principal residence, rental property, etc. At the same time, as per the Income Tax Act, your lawyer must hold in trust 25% of the gross proceeds of sale. So for example, if you're selling the property for $1 million, 25%, 250,000 is going to be held by your lawyer in trust until such time the certificates of compliance are issued by the CRA. And if your property is in Quebec, that applies to CRA applications and Revenue Quebec applications. So there's additional filings. So during the processing of the applications, CRA is going to ask for a payment of 25% of the net capital gain. That money is going to be paid from the funds that your lawyer is holding in trust. Then once the CRA receives payment in about, I would say, 2 to 4 weeks from that date, they issue the certificates. Now, 2 disclaimers. One, as per the Income Tax Act, when you have rental property, a lawyer or a buyer can request that your lawyer holds in trust 50% of the gross proceeds. As you can imagine, that's a huge amount. If you're selling a property for $1 million, 50% is 500,000. I don't see this happen often. I would say maybe 5% of the time. It really depends on the lawyer you're working with, etc. Second disclaimer, the largest concern for non-residents in this whole scenario is that it takes about 4 to 6 months, closer to 6 months, for CRA to process and issue the certificates. So what that means is that for 6 months, your lawyer is holding on to 25% of the gross proceeds, which could be hundreds of thousands of dollars, which you will not have access to if you want to buy another property or diversify those funds elsewhere. Now, that's part one. Part two of the sale process is that the following year, as a non-resident, you're required to file a non-resident Canadian tax return. And on that tax return, you report selling related expenses such as realtor commission, legal fees, accounting fees. That helps lower your capital gain even further. And on the tax return, you're only taxed on 50% of your capital gain. So at that point, CRA normally issues a good chunk of a refund. maybe half or even more, depending, of course, on your specific sale and situation, of the money that they collected at the time of the certificates. So at the time of the certificate, they collect a total of 25% of the net capital gain. At the time of the tax return, you're taxed on only 50% of the net capital gain. So they're holding on to more money than is required. But of course, they want you to file a tax return, and that's how you're going to get refunded.
Ruby, thank you so much for joining us. Thank you so much for all your advice. This has been great.
Thank you so much. It's my pleasure. And I look forward to catching up again soon.
Thanks so much.